Okay, so very good morning. Tuesday the 5th of June. Hope you are well. Just going straight into things, going to have a bit of a recap of some of the main news articles that are being looked at this morning, have a look at the way the charts are set up and then what to expect for the trading day ahead. Got a solo performance again today. Sam tied up with other things, so getting straight underway and looking at the close on Wall Street last night. You had a positive finish. In fact, the Russell 2000, which is the small caps in the US, and the NASDAQ Composite hitting fresh record highs again. And we're going to have a look at the equity markets and the technology sector in a little bit more detail in particular. But you can see that it's kind of crept over in through the Asian session to the European Open this morning. You can see here in the center left chart, the DAX on the front foot, just having a test up at around the late afternoon highs that we printed yesterday. Anything above here, then obviously you'd be looking at the highs that we printed. This would be yesterday morning. But in the S&P, if we just have a quick look there, you can see that really, if we look at this rally that we have had really over the last two trading sessions, this has been a combination really of this center point here, that most largest volatility on that wick is the release of non-farm payrolls, which subsequently broke the high end of the last week's range. And then since that point, we've managed to just edge higher, as you can see here in the SPOOs, most reflective of obviously all the different sectors within the S&P. A couple of different points here as we evaluate the US equity market on the kind of next potential moves. And well, first of all, just looking at the broader picture, this was something that I was kind of talking about in the weekly strategy report, which was this kind of, if I just mark it up, this kind of area of consolidation that we'd really been in through much of the month of May. Yes, there was a brief momentary break on the downside, but really that had kind of defined that 2700 to 2740 kind of area, the price action for that period, with the kind of subsequent trend lines here on top and bottom. But we've managed to break above there. Actually, you can see it, just the last kind of candle just above there. And as you can see from the text and the notation there, it's really, I think, for this week, given the fact that we're heading into the Fed meeting next week, next Wednesday in fact. We're looking for the Fed to hike rates once again for the second time this year as part of their 3 on their commitment for the period of 2018. But economic data is relatively light from the States now that non-farms has passed. And we're in a blackout period now for FOMC speakers as per the usual practice ahead of that meeting. So what's interesting is from a technical perspective, even though there are some uncertainties about how this trade situation is going to play out, it seems as though the market is relatively comfortable with the fact that this is potentially just the regular Trump tactic. He kind of talks it up a big game, and then we get to the actual event in itself, and what materializes is something that looks starkly different from the aggressiveness of his initial starting point in terms of this trade negotiation. And so equity markets still remaining pretty buoyant. And now that we've technically broken this range, the question is, well, where's the next kind of area on the upside? And these were kind of areas I had marked up, kind of the previous high points going back really to the beginning and the end of March, with this kind of capped off with the latter point being the 2800 psychological level. And I was just having a look at a couple of research notes this morning. And on this point of the equity markets, I did see a graphic here. Well, let me switch over charts. This was what analysts at Morgan Stanley are looking at. Well, if I quickly flick back to the original chart we were looking at, so this is the 2800 is the top side here, and so where MS are looking at is basically the area above there. And so they're looking at the S&P may reach 2800 to 2825 short term. I.e. in the coming weeks. So yeah, again, they're looking at the same kind of price movement that we have been doing over the last day or so. And now that we've managed to get our heads above there, we're kind of targeting those previous highs from Feb, March and they're in fact looking for a push just above the handle. One of the underlying, obviously, reasons for equity strength is the technology sector. And analysts at Goldman Sachs this morning, they're being kind of publicized in a Bloomberg article that Goldman's doesn't think there's a bubble in the tech stocks. And in fact, they kind of go through various arguments to suggest that actually there's some more to come. And this movement higher in equity markets is validated by some solid kind of micro fundamentals, if you like. And what they're looking at is the tech sector. And we're not talking about FANGs, we're talking about FAM, which is basically FAAMG. So this is Facebook, Amazon, Apple, Microsoft, and Google. So I guess if you think of it as in the biggest technology companies, and in fact those names I just mentioned, so those 1, 2, 3, 4, 5 companies now have a value of $3.8 trillion, which, to put it in some perspective, is larger than the annual gross domestic product of Germany. So those 5 countries are now larger than the GDP of Germany, if you can believe that. But an interesting chart here is this one. I mean, the performance of tech giants outpacing other stocks is quite phenomenal. What you're looking at here is a white line showing well, this is the traditional FANG stocks. So this would be Facebook, Amazon, Netflix, and Google, comparative to the benchmark S&P 500. And that is just incredible. Over where we were, which was evens back at the beginning of 2013 to where we are in 2018. You know, we're looking at a move of nearly 850% for the FANGs, comparative to something like 75% in case of the S&P. So, massive divergence. Now, what Goldman's are saying, their analysts, is that obviously people draw, when you see this type of price movement and this divergence, people typically tend to start picking it apart, thinking that, well, are we going to get a rerun of the dot-com frenzy of the late 90s? That's probably the most obvious one given the sector we're talking about. But Goldman's point out a couple things, and one of those is that while tech stocks occupy all top 5 spots in the market for the first time ever, the group's price-earnings ratio, they say, is relatively subdued at 22.6 times earnings. The FAAMG, so those 5 major companies, that block fetches a multiple that's less than half of what the then big 5 in the dot-com bubble was back in the 90s. So, those multiples are nowhere near as stretched on a like-for-like comparative basis. Unlike then the technology mania of the 90s, most of the success, Goldman say, can be explained by strong fundamentals, these being revenues and earnings rather than speculation about the future. I guess you could argue that as a point, but certainly, the numbers don't lie, and on those multiples, on the price-earnings ratios, certainly, it's quite a compelling case. And despite the blips that we've had, namely Facebook more recently on the data privacy scandal, the Amazon on being called out by Donald Trump, on the fear of policy tightening that we had back in February, tech stocks still really are the underlying force that's driving this equity move. And as I said last night, NASDAQ comp, record high, Russell 2000, record high. So here we are, the S&P comparative is slightly lagging that of the more tech-oriented NASDAQ indices, but most banks, MS being one, as I mentioned, looking for further upside. Again, for me this week, what's going to be pivotal is really what comes out of these trade talks. That dialogue is really going to be, I think, the catalyst for direction. But it seems as though the market is fairly confident that this is going to go the way that most of these trade talks have gone thus far, which is, in the end, Trump tends to kind of tone it down, and then we do get some kind of positive progression in talks, if anything. So let's see. Definitely is something you're going to have to keep an eye out for as we go forward. Quick look at some other things. I'm not going to dwell too much on this because ultimately the Aussie currency really has done very little. But overnight, so you're up to speed, Australia held their key rate at 1.5%. That was very much as expected. They said the board, judged policy as consistent with sustainable economic growth and reaching inflation targets. So I think that pretty much summarizes it. No surprises and consequently no major move in the Aussie from overnight. A few other things from overnight. Chinese service growth gauge unchanged in May. So really not too much for me to add here, but a fairly constant picture on the service side, which obviously complements an improving manufacturing PMI reading more recently from China. So if you were looking for any kind of signs of optimism, then certainly some of these major readings have been fairly consistent and in a positive way. So does that also help the kind of global narrative on the growth side? Certainly it would lend its hand to that point of view. Another news item, which obviously a few people are looking at this morning, it's the kind of the front page story of the FT, and it's Theresa May, of course. Can only go a few days before Brexit rears its ugly head again, and Theresa May has abandoned plans to present European leaders with a detailed blueprint for a future UK-EU relationship, and this comes, of course, ahead of a key Brussels summit this month. A decision taken as business leaders, you may have read, have been losing faith in her handling of Brexit. There's been quite a few, I was looking at Twitter last night, a few unnamed senior kind of backers of May, which apparently are losing faith, and if she continues down this path, it's only a matter of time before she has to go. So that's still there lingering in the background, the kind of uncertainty about the longevity of her ability to lead the government. To give you an idea, senior government officials said Mrs May now plans to publish this detailed blueprint plan after the European Council meetings. As a reminder, that happens June 28th to 29th. And this is in spite of earlier claims that it would help to shape debate ahead of the summit. So again, the main sticking point that most people are pointing to is the customs union, this idea about the border issue in Northern Ireland and the Republic. How is this impacting the pound? Well, quite frankly, it isn't, because I think this is, again, when it comes to the Brexit narrative, I think this particular type of commentary is very much priced in. I don't think any of this is particularly new, and I think delaying on this type of detailed documents, particularly on the customs union, is pretty much what people expect at this point. So yeah, looking at the cable price action, we've kind of, I guess, just consolidated, been fairly sideways since really European participants left markets yesterday, after we saw that kind of resurgent dollar push the pair lower through a fairly significant level around 133.50 yesterday. Kind of remained sub-pivot this morning. So probably just be keeping an eye on the range low from the Asia Pac session, which was kind of the low point from yesterday late afternoon, around 133.10. If we retest the lower bound, you can see there that that's kind of also played out back in previous days gone by. And this is the Asian kind of range. Below that, then probably looking down here towards S1, and then the low that we had towards what would have been Friday session would come in down here. On the upside, obviously any push to, you can see that kind of double top that you've got from yesterday evening and what we've already tested this morning, which is just a few pips shy of the pivot level. That's probably your first marker of resistance. Any push on that then would bring into play probably again that level, which was a key kind of catalyst for the run lower yesterday, would turn resistance on the upside around 53. Was that previous highs back there, which would have been last Thursday, and then that low point seen on Friday morning before the break that came later on. So we're a little bit mid-range at the moment, looking from a broader perspective in that point of view. Quick look at the euro currency just while we're looking at FX. And likewise, looking at this type of time frames, this is a 30-minute candlestick. It's pretty again, mid-range. Nothing really here is screaming out of interest at this point. But looking on a broader perspective, you know, this was again something that I'd marked up from the weekly strategy we issued yesterday, and from a macro point of view, we've discussed a couple of times. Really, the key theme here is the trade talks, and if between now and Friday, the US maintain this kind of quite staunch protectionist stance, then if that weakens the dollar, then this may play into the hands of supportive of the euro-dollar pair, given the relative period of stability that appears to have returned to some of those European assets, i.e. Italian and Spain, after the volatility that was seen last week. Then on an upside, really, we've got to get ourselves out of this kind of area of this, I guess, 50 pip kind of price range that we've been in over the last week or so. We got close to breaking that yesterday. We had a run up towards those highs that were seen back at the end of late May, but really failed to breach it. But that's the kind of areas there I've just had marked up from yesterday, a rectangle that I'll be looking at for potential kind of targets on any move if we can get ourselves above that high from yesterday. So 117.68 and 91 the handle, 18 just shy of that would be points of interest I'll be looking at. On the downside, you've got to think that area down here, that 116.60 in the futures, is going to be a pretty strong area of support, that being the relative low from the much of what defined last week's session, and also back on the kind of 25th of May as well. Okay, quick look. Finally, there's one graphic that I saw last night. I'll pop this in the chat room. I just thought it was quite interesting to give you a kind of state of play, and as I kind of was sharing those ideas in the strategy on Monday, I kind of feel like the market has got over this short-term episode of negativity over the Italian situation, and as a net result, the spreads were tightening as yields in Italy were reverting back to pre-spike levels that we had this time last week. But that doesn't mean, I think, that the Italian situation is concluded. Far from it. I think that it's going to rear its head again. It's just a matter of time. Now the government formation has kind of been made. These are kind of the key pivot points on the calendar for the second half of this year. And some of the key ones here are predominantly rating agency led. And you know, rating agencies have kind of dropped off the radar of significance since the kind of sovereign crisis passed a number of years ago. But it could come back to the forefront for market kind of sensitivity to commentary. If you remember, I think it was Moody's who commented on Italy about 2 weeks ago, saying that essentially the government plans that have been put together from the 5-star and the League would make the fiscal situation highly complicated in a negative fashion, with reviews to the sovereignty to be downgraded, was what they were saying at the time. They're kind of quite ambitious spending plans and so on and so forth. So you've got DBRS, which is kind of seen as the fourth of the major rating agencies, but the other ones, you've got Fitch happening in August, Moody's in September, S&P happening in October. Then obviously from the red point of views, these are the more political oriented kind of events. You've got the summit happening. So aside from Brexit, Italy is obviously going to be a big talking point when those various high-ranking officials meet at the end of this month. Then you've got September, October, and then going forward thereafter. The deadline for the budget, that's going to be a big one right at the end of the year, to see how they do look to kind of balance their books, so to speak, going forward. So again, something to just be aware of. I guess this is for anyone holding longer term positions. If you want to kind of navigate yourself around where the potential flare-ups could be of Italian nervousness, then certainly this could be quite a telling picture. All right, quick look at the calendar for today. Coming up at 9:30, you're going to get some interesting UK data. Before that, though, I must comment, we have had the service PMIs coming out of Europe. Italy, a little bit higher than expected. France just coming in basically in line. So not much in the way of any knee-jerk reaction, I think, as you would expect. But the UK one obviously carries a degree of importance, just giving the gearing of our economy towards that specific sector. This is looking at the month of May. But if you remember, the month of May, I think if I'm right, was the hottest May on record. So after we had the beast from the east kind of have a large knock-on effect to negative retail performance in the UK, it's going to be interesting to see whether or not the more warmer weather lent its hand to the service sector, which one would think would probably have been the case. Expectations are for basically unchanged from the prior figure at 53.9, fairly tight range, 53.8 on the low to 54.1 on the high. Excuse me, I'm looking at the UK one here. So we're looking at 53, the previous was 52.8, my apologies. So looking for a slight improvement on last month. Got a range here, 51.5 to 54. That makes a bit more sense. So let's have a look at that, what it looks like. 54, even though that would be the top end of expectation, that by no means would be, I think, a huge surprise. We were there only, 3 months ago. We have been even higher. Check out October of 2017. We were punching up near 56. So on the flip side, a 51 would be fairly interesting. That certainly puts us on a low for the last 12 months. If we go on a 5-year, I mean, we start looking down to the lows since 2016. If that were to be the case and we came in at the low end of expectation. So on that basis, obviously we were just discussing looking at cable, those kind of areas on near term for downside levels, that quite key 133.10. Certainly that could be tested if we did get a breach of the lower bound, because that would be the lowest in 2.5 years or so. On the upside, I think that's more limited because the data set would suggest that we have been higher more recently. Actually, we've had a bit of a dip, if anything, over the March period, and a bit of a recovery in April. Finally, going back to the calendar, other than the UK number, which again FX traders will need to look out for, in the afternoon you've got the ISM non-manufacturing PMI coming out of the US, so there's no major really 130s. You're going to be looking out for 3 p.m. for that data alongside JOLTS, and then the API crude inventories as per usual later on this evening. You do have a Bank of England speaker as well. There's quite a few this week, in fact. So just given where we are at the moment, I guess the main areas of significance are the inflationary situation, which has in economic data in the UK stabilised, but where does it go next? So any hint towards an insight as to what the projections are from these MPC members would be quite interesting. In addition, of course, to the Brexit uncertainty, how much of that does kind of translate into forecasting of economic growth for the UK going forward. So it's Cunliffe who's speaking at a Futures Industry Association. That's happening at 11 o'clock. Let me just bring into shot this slide that Charlie made for me. And this is your reminder of the hawk-dove spectrum of the Bank of England MPC members. And so what you've got here is Cunliffe sitting as a deputy director and erring on the side of being more dovish. If you remember, whenever there's a dissenting vote, it's either usually these two in the bottom right who are dissenting in a hawkish fashion, or it's these two on the left, Ramsden and Cunliffe, who dissent in a dovish way. So you can probably expect a repeat of that, but that should give you a reference point as to what he says, whether it's in line or not. So remember to reflect back on your hawk-dove scales in preparation. All right, that's pretty much it. I'm going to let you get on with it. It's coming up to 9 o'clock, UK data coming out at 9:30. So I wish you a good day, and if you need any assistance, I'll be available in the chat room throughout the day. But overall, we've got a relative positive open. Equity markets in particular gaining quite a bit of the spotlight, brushing aside any uncertainty on the trade war situation ahead of the G7 summit at the weekend. Record highs in the Nasdaq comp And the Russell 2000 small caps last night. Technology still a focus. And nothing really to detract, I think, that might not continue throughout today as well. So just keep an eye on the equity markets as a bit of a marker for sentiment short term. Okay, guys, have a good day.